Bismillahir Rahmanir Rahim. Assalamu alaikum and good afternoon, ladies and gentlemen. A very warm welcome to today's Monetary Policy Analyst briefing. I am pleased to share that we've been joined by Governor Mr. Jameel Ahmed and other senior SBP officials. So without further delay, I would request Governor Saab for his permission to start the proceedings.
Assalamu alaikum and good afternoon to everybody. Yeah, Noor Saab, we can start.
Okay, thank you, Governor. So this briefing basically comprises of Governor Saab's opening remarks and then a presentation deck by Mr. Amin Lodi, Executive Director, SBP, and then a Q&A session by Governor SBP. So, Governor Saab,
yeah,
yes, please.
Amin Saab, you can start with the presentation and then I will come later.
So we'll start with Amin Saab's presentation. Amin Saab, if you could project your slides, please.
Yeah, thank you, Noor Saab. Thank you, Governor
Over
Saab.
to you,
I hope you can see the slides now, Noor Saab. Can you please confirm?
Yes, sir. Yes, sir. The slides are visible now.
Thank you.
Slides are visible, yeah.
So good morning, good afternoon, good evening, everyone. Assalamu alaikum, depending from where you're joining. I hope you get a chance to see what the decision of monetary policy and also get a chance to review the monetary policy statement. So as usual in this deck, I'll try to cover some of the key trends in our economy and which monetary policy have, of course, reviewed more carefully in addition to the projections of these variables. So if I go on the next slide, and as you know that Monetary Policy Committee today decided to keep the policy rate unchanged at 12%. In this graph, you can see the policy rate trajectory by the black line. And then we have like light blue line, which is headline inflation, and the red is the core inflation. So, the Monetary Policy Committee started easing monetary policy since June 2024. Before that, the policy rate was 22%. And in the next 6th meeting till January 2025, the monetary policy has cut the policy rate by 10 percentage point to reduce it to 12%. And today, they decided to maintain it. The monetary policy asserts that this current policy rate on forward-looking basis, its real value is appropriate to stabilize inflation within the target range and also to ensure overall macroeconomic stability. While this is also helpful, would be helpful in supporting the ongoing momentum in the economic growth. So the cut that monetary policy has already done is materializing now. It's more visible in the economic data, and going forward, expected to further unfold. So all in all, this is supporting the economic activity and also helping us keeping the pressures on external and inflation in check. So monetary policy hold it in this meeting. If I go on the next slide, and in the next few slides, I'll try to cover in more detail the trends in inflation and its different components. So if we can divide the inflation into 3 major components that we usually look at. So in this picture, you can see the trend in all 3, as well as the headline inflation. The headline inflation is shown in red, then yellow is energy, food is shown in blue, and green is the core trajectory. So, well, you can see this the blue line, which was the food inflation. It went very high in the past few years, as high as like 50%, then it came down last year. And since May 2024, it has been at low levels. So recently, in the recent month, we also seen it to decline. Is actually the food basket, the prices are showing a deflation in the last 2 months, and in the recent time, it's mainly the perishable items which have been the main driver, and which is the key commodity prices in the food basket has already come down, so that has pushed the inflation down, and now the perishable prices in the last 2 months have come down very significantly, and that has contributed to bring this food inflation further down and also push the overall inflation down. I'll discuss that in more detail in the next slide. But before I go on that, if you look at this yellow line, which is the energy inflation, again, it has remained very volatile in the past, and it has been declining since last a year or so. And in this, we all know that government initially was passing on the subsidies, and then they have increased the gas prices and electricity prices in the last year substantially. And now the base effect that remained for almost a year now waning out, and recently the adjustment in electricity prices the government has made were also favoring to bring this down. I'll discuss that in a more detail in coming slide. If I go on next slide and see what's happening on the food, here we have three panels in the figure one. We have divided the food inflation into core and the perishable food items, which is yellow, and the non-perishable food items, which are in blue. So you can see that food inflation in the non-perishable item has already come down significantly for almost since March, April last year. And the yellow, the perishable items, they were volatile. They were sometimes pushing it up or bringing it down. So in the last 2 months, we can see the yellow portion that has pushed the inflation further, food inflation further down into negative territory. So the nature of these perishable items is such that they have been very volatile in the past, and they expect to remain volatile. So that you can see in the figure 2 is show the D-mean of the perishable prices and their volatility. So they come down, but they also increase the cycle of like 2 to 3 months. So they can reverse quite sharply. So that risks remain. So while assessing the future path of inflation and its projections, the monetary policy do review it, like what's the possibility and why these perishables are down. So we also discussed that in detail. So I think one thing which was a surprise to the market and also for us was normally we see before the Ramzan, the prices of the vegetable and the perishable food and vegetable and fruit items, they usually increase. But this time, at least this was not clearly visible in case of vegetables. So what is happening behind is the anecdote suggests that some of the area under the wheat cultivation, which has gone down this year, so the farmers have shifted to some of these vegetable on the minor crops. So that's is the supply was good in pre-Ramzan in the market, and the prices remain either stable or actually have come down. So we have not seen the usual seasonality that we see before Ramzan in these prices. So they're keeping it down. And then, but having said that, risks remain that these prices may reverse in the coming months. And so when the monetary policy was analyzing the future course of inflation, so they do take into account the probability or possibility of these prices to be reversing in the coming month. In the figure 3, it is more other food items which fall in the non-perishable basket, but these are the key food items which normally we consume. For example, wheat flour, cooking oil, vegetable ghee, rice, sugar. So again, so these are again the items, the prices which have been moderate or have come down, have actually declined in the past few years, past few months, I would say. So now their base effect would be vanishing, or it would be going out after the 12 months. So that and the prices would be normalizing, or its impact on the inflation would be normalizing. And some of these items have started showing increase. For example, the oil, vegetable, and cooking oil, their prices start increasing. So that is also a reflection of what is happening in the international market to these prices. So they are also being reflected or passed on in the domestic prices. So again, this food inflation, it is expected to remain moderate overall, but it may reverse from the levels from where they are. If I go on the next slide and do the same analysis for the energy prices. So as I said, in the past, government has been passing on the subsidies and then also increasing the gas and electricity prices. The electricity prices you can see in the red, the gas prices were in light blue. So they were major contributor when the inflation were increasing or were at the elevated level last year. Again, they have the large base effect when they were out from the calculation of the year-on inflation. So now the inflation in the energy inflation has come down. And recently, because of the favorable supply side factors like international oil prices have come down, the exchange rate has been relatively stable compared to what perhaps the government has assumed at the start of the year in their base tariff. So they have been passing on these prices or reducing these prices, and that has also bring down the energy inflation. So what will be the course of inflation? It's expected to remain moderate going forward, but it will depend on like if government has to make any adjustment in the electricity or gas prices. So far, it seems like they remain favorable as we move forward. If I go on the next slide and come on the core part of the inflation, so here we have divided this into three components, two components, the good and services, and the green is the overall core inflation. So if you look at the red, which is the services, so unlike many other countries of the global general trend, so services core inflation has come down. Pakistan much more swiftly is close to historical average. However, the goods inflation is still elevated. We expect this to come down in the coming months in a more moderate levels, and this will push the overall core inflation further down. But this has been in the past few months, we have seen it is proving much more stickier than what was anticipated, and also remaining somewhat elevated, unlike what we have seen in the food and the energy basket. So if the food prices start coming up and energy reverse, so overall, this can push the inflation higher. But as I said, like monetary policy, when it assesses the current monetary policy stand, the real positive rate that we have even on the forward-looking basis, so we expect overall inflation to stabilize within the target range. And this is what the priority of the monetary policy is. So they're committed to keep it or stabilize it within the inflation range. If I go on the next slide, again, a success, perhaps the direction is right, but it's still the market. So let me first explain what this graph is. So red line is showing 1 year ahead projections of the professional forecaster. So most of you actually participate in the survey that we conduct. Thank you for your participation and sharing your inflation projections. So we asked you for the 1 year ahead projection and 2 year projection, and we have plotted this over time, how this has evolved. In the red line, this is 1 year ahead projection, and the green is a 2 year projection. So that is converging to, or is moving towards the target range. It's not quite there, but if we, for example, see what was your projection for 1 year ahead and 2 year ahead almost a year ago, so some of you were expecting that it would be around 15% or even higher. So that has actually come down. So we expect as inflation will stabilize within the target range, so that should also come down to this inflation or get more anchored with our medium-term target range. If I, if I turn to the next phase, which is like what's happening on the growth, this is the heat map we usually show you. So if you look at this, the numbers, as we move on the right, so it's turning more greener or yellow shade from the red. Still, you can see some red, some dark red, which is like consumer credit or perhaps the fertilizer offtake, and then some construction-related sector, though they are also turning yellow, for example, domestic cement sale. So, but now they are shifting towards more greener or the yellow shade. So these high economic indicators are suggesting some improvement in economic activity as we are moving along during this fiscal year. but these are yet to be shown in the official data. For example, for LSM, or so far we just have the data for first quarter of GDP. So we all know that that was a bit low, but as we are moving and during this year, and the interest rate that has come down now, after their usual transmission lag start to affecting the real economic variables, so that that activity is gaining traction, and we expect our projections are suggesting that this will gain further traction as we move during this year in the second half. If I go on the next slide and show you, this is the activity on the agriculture sector. We all know the outcome for the kharif crop. But in the rabi crop, in this season we have the wheat is the major crop. So here in the figure 1, I've shown you the area under cultivation. So that come down compared to the last year, about a 7 percentage point decline compared to last year. But when we met last time, and this is what we have in the figure 2, I've shown you that the last time as well. So this is showing the vegetation index from the satellite imagery that we collect and regularly monitor. So when we met last time, so it was showing, and this is by the way, is an indicator for the yield, as you know. So when we met last time, it was showing a much more negative, like around 4.4% decline in the yield. So it's still showing a decline compared to last year, but it has recovered. So the recent rain and the improved moisture has somewhat subsided the downside risk that were also coming because of the yield, in top of in addition to the area under cultivation that has gone down. So we expect this to improve further as the rains are continuing, and particularly in the Punjab, we have seen that the yields has improved, or NDVIs are showing a better trajectory now compared to what we have seen at the time of last Monetary Policy Committee. Similarly, if I go on the next slide and show you what's happening on the LSM. So last Monetary Policy, we have just one data point for December. The month-on-month was quite high, but still the LSM remain in red. There are few sectors which are showing positive momentum, either yellow or green. So it's a textile, POL, auto, cement, which was have been in red, slightly turn into positive, and we expect this to get more yellowish at least, but it remains to be seen. There are risks. So there are some heavyweight items which have more weight in the LSMs are showing growth, but at the same time there are few sectors or subsectors which are pulling it down, and some of these have, as we discussed last time as well, the furniture, for example, has a very little weight and very little backward and forward linkages with the economic activity, but they are dragging the LSM growth down. So if you exclude that, so LSM turn into a positive. Having said this, we do expect as we move in the next half that this LSM growth will also start. It will bottom out and start or turn into a positive number. If I go on the next slide and show you another indicator of economic activity, NO2 level, whether you look at the NO2 levels or the carbon dioxide emission levels, so they both are showing YOY increase in the same period. If we compare current months with the last year, the same period, so that has shown, and overall it's showing an improvement of around 7%. Here in the figure 1, we have just shown you the Karachi compared last year and this year, so it's getting more reddish. Similarly, if you look at the Lahore and Faisalabad, so they are turning either more yellowish or more. In case of Lahore, it's like less red, but Faisalabad, which has more weight in the LSM compared to even Karachi and Lahore, so they are showing much more yellow shade Last year, they were green. So this is also indicating that economic activity slowly and gradually is picking up. If I go in the next slide. So here, these are the numbers based on our surveys. Normally, we show you. So in the figure, when we have the capacity utilization, February number is better than what we have seen in the last February or in the past few months. In the figure 2, we have PMI. So then again, since this is in diffusion index, more than 50 mean, as you know, is more positive responses than negative responses. So that is above 50 and it has improved. So it has been improving last 2-3 months. And we expect this will also translate into higher economic activity in the coming months. So this is a reflection or leading indicator for that. Similarly, if you look at the question that we asked on the employment, so both the current and the future, it is the responses that we are getting in the latest survey are showing improvement. So they are in positive territory and improving. So we expect this all to translate into higher economic activity, these indicators to in a better growth numbers as we get more data on LSM and GDP in the coming months. If I go on the next slide and turn on to the external sector, I'm sure you have seen this data, a current account which has been in surplus for a few months, turn into a deficit in January. This was expected. We were anticipating that as the economic activity will pick up, so it will also reflect in higher imports, and that we are seeing. But overall, what's happening is that exports are also growing, along with the remittances, which remain robust around 3 billion, and expected to improve in this month and the coming month as we have like Eid-related seasonality. So that all in all are helping in financing this most of this increase in trade balance and the primary income deficit that we have seen. So overall, the current account deficit assessment of the monetary policy is that is expected to remain into a deficit or a surplus of around 0.5% of GDP, which is quite a moderate level. And it is better than what, as you know, was what we were anticipating at the start of the year, or what IMF was projecting at the start of the year. So it is still better. But nevertheless, monetary policy do look at like the imports which are growing. So it's what's its future course. Some of these were due to factors which were, for example, in November, after November, we have like higher imports for POL, and both the volume of the POL imports were increased, but at the same time, the prices that were prevailing at that time, or higher prices that were prevailing at that time, have also taken the toll. So going forward, we do see some respite from those prices, but as I said, like as economic activity will gradually pick up, so it will have some impact on import, and overall our current account deficit would drain between 0.5 deficit to a 0.5 surplus. If I go on in the next slide and show you more detail of what's happening on import and export in volume and unit value term. So in the figure 1, you can see the imports have recovered from a negative growth last year in this July-January period. So now they are showing a growth of around 11%. And if I divide this into oil and non-oil, so this mainly coming from non-oil. So oil, so far, it has not contributed in the growth. But if you look at in the figure 2, so oil volume in the recent 2 months, as I was mentioning earlier, have picked up. So they have contributed oil in the recent month, but the prices have been favorable. That you can see in the figure 3 with the yellow line. So the prices have down, so that has offset the impact that we have on the higher import volume of oil that we have imported so far. The other component, which is the non-oil, if you look at its volume is growing significantly, and the prices now they are stabilizing, somewhat increase. For example, we have seen the increase in the palm oil prices and steel prices, which are part of our imports, and similarly some other commodity prices, but they are more or less stabilizing. The volume have shown significant growth. So that has contributed mainly in the import growth during this fiscal year, and we expect the economic activity to continue. Maybe the volume the growth will stay, and the prices so far have been favorable. So overall, our import, we expect this to remain roughly around this. The growth will remain roughly around these levels. If I go on the next slide and tell you the story about the similar story about the exports. So exports are also growing, and they have grown on top of the 8.4% growth that we have seen last year. This year, in the July-Jan period, there's a growth of around 7.6%. So what is contributing? So again, we have divided into three components: the rice, which is shown in yellow; purple is HVA, textile, and all other items are shown in gray. So there's some negative contribution coming from the rice. Last year, we have seen a significant growth coming from the rice as well, which is missing this time. And this is not because of the volume. We're still sending more, exporting more volume of rice, but the prices are not favorable. The global prices have come down, so that has pushed this contribution of rice and overall export into negative. But if you look at the HVA, textile, and others, so the volume are growing, and the prices or the unit price that we are reaping from the market has also gone up. So the high value textile is contributing in the growth, and they're expected to continue in the coming month as well. If I go on the next slide, so this is the story on the worker remittances. So worker remittances, have been around 3 billion on average. So and this one we're expecting even a higher number because of the seasonality that we have for the Ramzan. So all in all, if I can say, the worker remittances and exports, they will help financing any increase in the import that we are anticipating and keeping the check on overall current account balance. If I go on the next slide, so the financial inflows, they have been relatively low this year compared to last year number that we have seen. FDI is better than last year, the private inflows that is shown in the green. But if you look at the net option inflows, they are in negative. So far, we have made more repayments of offshore debt than the inflows. So part of this is because most of these inflows were planned in the even initially under the IMF program in the second half, and we're expecting after the review these inflows will materialize, and the debt repayments were were in the first half, so that have been made. So with this, we expect in the coming months these financial inflows to improve, but that remain to be seen. So far, they have been low. So we have been able to build out of reserves, that is in figure 2, through contained current account deficit and also the positive inflows, net financial inflows that we have seen so far. As I said, like going forward, there will less pressure of the debt repayment and more inflows are expected. So that should help building our reserve comfortably to above 13 billion, that the target that we have set for ourselves. And in the figure 3, this is to show you like the trajectory of our forward liabilities, that the swap that we do with the local banks, the central bank. So that book has been reduced. That has further come down, even in the current fiscal year. So we have not reduced it, our reserve definitely would have been higher. So we are maintaining that discipline, keeping it the forward lower, and also building our reserve. So and monetary policy emphasized the need to further build up of reserve as we move in the next year. So we'll want to continue this trajectory. If I go on the next slide and to update you on the fiscal numbers that are released after the last monetary policy, it was expected that in the first half of the fiscal, primary balance and overall balance will improve, and so is the case that we can see in the figure 1. The data is suggesting compared to last year, and most of that improvement was not surprisingly coming from the higher SPP profit or non-tax revenue that government has collected during this period. But at the same time, there are also there was some saving from the expenditure side, particularly if you look at the yellow. So it was last year in the same period, the first half, it was around 4.1% of GDP, non-interest current expenditure. This year it is around 4%. So government has been able to curtail the subsidy in the first half. So that is helping, is also helping in containing overall fiscal and the primary balance during the first half. Nevertheless, if we look at the revenue, and I'm sure you are seeing that data, so there are some risks, which is also one policy has also viewed that so now that it is becoming challenging for government to collect all the revenues. The growth has been significant, around 26%, considering the inflation has come down, considering the growth is nominal GDP growth is low. This is quite a remarkable performance on that part, but it is falling short of the target and becoming even challenging for making it challenging for the fiscal authorities to keep this primary balance closer to the target of 2.1%. So it could prove challenging, or government may take some additional measures. So if I go on the last slide that I have on the monetary. So monetary, if you look at the figure 1, the M2 growth is coming down gradually. There's a decelerating, and this is in line with the overall non-GDP is coming down. And that was expected. Inflation is coming down. So, and this is mainly, this deceleration mainly contributed by NDA, while NFA almost maintained the similar contribution. If you see the figure 2, which is showing the composition from the liability side. So yes, we have seen some deceleration in the deposit, and more recently, as you know, that before the Ramzan, near the Ramzan, we see that currency circulation increase. So that has also, because of this recent seasonal factor, but there has been a case like currency circulation is now contributing towards M2 growth, which was not the case towards the end of last fiscal year. And in the figure 3, if we look at the current, this is showing you the private sector credit YOY growth. So it has increased till December in the first half, and now it has decelerated. The deceleration was expected. After this, in the second quarter, we have seen that banks were aggressively lending, and some of this credit was short-term, was related to ADR-related tax to avoid it, and it was expected that some of this will reverse. So we have seen this, and there's also a seasonality. After December, normally the credit price come down, so that has come down because of that, and also some reversal because of the aggressive lending the government, the banks were making to avoid the ADR tax. But nevertheless, if you look at even the current level, it's around 10%, which is significant compared to what we have seen in the last 2 years. So the credit to private sector, we expect to show a reasonable growth in this fiscal year. With this, let me just summarize. So overall, if we look at the current monetary policy, the policy rate, if you look at on forward-looking basis, is still significantly positive. That will help bringing the inflation, or especially the core inflation, further down, ensuring macroeconomic stability, and at the same time support the economic growth. This is assessment of the monetary policy, and then impact of this sizable reduction in the policy rate is materializing. It will help improving the growth momentum as we move along. Export and worker remittances, they are positive, strong, and they are helping us financing the import, which are growing in line with the economic activity. And we expect that with the improvement in the financial inflows and the inflows we expected in the second half, so we'll be able to improve our FX reserve of 13 billion. Fiscal so far has been contained, and monetary policy assesses that is very important for fiscal to continue this consolidation so that overall macroeconomic stability can be achieved. And government has been very cautious on its expenditure. They have been making efforts to improve revenue, and that should help containing the fiscal deficit overall, and also having a primary surplus in this fiscal year as well. And the monetary growth is coming down, decelerating. It's mainly coming because of the NDA, credit private sector is significant. And so overall financial conditions are easing, so that should keep it at a reasonable level in this fiscal year. So let me stop here. Over to you, Nusa, for the question and answer.
Thank you, Amin Saab, for the comprehensive presentation. Before we go into the Q&A, I would request Governor Saab to say his opening remarks.
Thank you, Noor Saab, and thank you, Amin. I will say a few words before we go to the question and answer. Just few points. First of all, as Amin has also said, that the core inflation is proving to be sticky, although the overall inflation has come down to 1.5% last month, and that mainly is on the back of sharp reduction in food and energy inflation, but core is still persistently high. Second point just wanted to mention was about the rising trend in imports, as Amin has also shared some of the data also. And particularly when we look last year, fiscal year 2023, mid of 2023, in June, when the imports mainly bottomed out. So since then, there is a substantial increase in imports over a period of time, and it's quite broad-based. And when we segregate into the impact of volumes and the price increases, so we see the import value has increased mainly on the back of increased level of volume of imports. When we compare with June 2023, almost 40% increase is there in the in imports in volume terms, and the overall value of the import is still manageable because of the reason that the global prices has not increased sharply, and that's a help in containing the overall import level. But volumes have already significantly increased. This also shows the level of economic activity is rising, particularly in the recent months. Despite this increase in imports, volume and overall value, the current account deficit is still assessed to be remaining within the range of 0.5 to plus minus 0.5% of the GDP. And that is mainly because of increasing level of remittances. Remittances for the first 7 months have averaged around $3 billion, and we are hoping that, in fact, we will be releasing the data today, and for the month of February, it will be $3.1 billion. So consistent flow of remittances has helped in containing the current account deficit. Then when we look at the GDP growth, I think the economic activity pickup is not fully reflected, particularly when we look at the first quarter of GDP, because the growth was only 0.9%. But when we go into details, we find that the GDP for first quarter was, the growth was lower side, mainly because of the reason that agriculture sector has not performed that well during first quarter, and it has dragged the overall growth. Agriculture in first quarter of fiscal year 2024 grew at 8.1%. And at that time, the overall growth for the first quarter was 2.3%. In first quarter of fiscal year 2025, the growth came down to 0.9%. But within that, when we look at the contribution of agriculture, it was agriculture grew only 1.2%. So that reduction from 8.1% to 1.2% has mainly dragged the growth for the first quarter. We have also made an assessment that if the agriculture growth for the first quarter of 2025 had been at the same level at it which was in the previous year, then actually the first quarter growth would have been around 2.6% as against 0.9%. And the overall full year assessment is that the growth for the current fiscal year would have been above 4% if we have been able to maintain the agriculture contribution at the same level. So I think the overall pickup in economic activity is there, but since the agriculture is not performing that well for the current fiscal year as compared to last year, so it has dragged the overall growth down. Lastly, I will just share the, as usual, the debt repayment update, and then we can have question answers. So for the current fiscal year, as I have been sharing the data previously also, that full year repayable amount on external debt was around $26 billion, which included the principal amount of close to $22 billion and interest of $4.1 billion. So total $26 billion. Out of that $26 billion, around $16 billion, $16.2 billion was expected to be either rolled over or refinanced. So this leaves us with repayable amount of slightly less than $10 billion. And out of that $10 billion repayable for the current fiscal year, already we have repaid close to $7 billion. So the remaining repayable amount for the current fiscal year is around $3 billion. On the rollovers, we have $3.7 billion which will be repaid and refinanced. And other than that, $12.5 billion was expected to be rolled over. So out of that $12.5 billion, $9.5 billion have already been rolled over. So it means that around $3 billion is remaining, which will become due in June. And at that time, we will take up for its rollover. So the rollovers for bulk of the amount has already been have done. Documentation have been executed, and remaining $3 billion will be done once it becomes due in June. Otherwise, the repayable amount out of $10 billion, as I said, more than close to $7 billion is already repaid. So $3 billion for the current fiscal year is remaining. So with that, maybe I can stop and we have questions.
Thank you, Governor Saab, for the remarks. Now, let me just make a couple of announcements. If you have a question, you can post it in the chat, or you can use the raise hand option. And as always, I'm in receipt of some advanced questions, so I'm going to, Governor Saab, prioritize those questions and post that to you. So the first set of questions is on inflation and interest rate in outlook. And the question is that last month, a newspaper quoted SPP governor's statement that policy rate will be in single digit in the months ahead. Since recent inflation has turned out better than expectation, why isn't SPP cutting rates more aggressively? Related to it is another question. Can we say that MPC is focusing more on core inflation in its decision making? And finally, on this same topic, there is a third question. Why is SPP fearful in providing forward guidance in current stable inflation environment? So I'll take a pause for you to answer these questions.
So first of all, on the outlook for policy rate, I think I never had given any kind of indication that what will be the policy rate going forward. I always have talked about the assessment of SBP or the assessment from the Monetary Policy Committee about the inflation, about the current account deficit, about the growth outlook, but I have never given any indication what will be either the policy rate or the exchange rate in future. We always talk about the decisions of the Monetary Policy Committee. So it's the prerogative of the Monetary Policy Committee to decide on the policy rate, and once the rate is decided by the committee, only then I will make an announcement and will never give any outlook on the policy rate. So it's mainly we talk about the macro indicators and State Bank's assessment about the future outlook of those indicators. Secondly, on core inflation versus headline inflation. So I will say that there is, and I have said this in the previous such briefings also, that there is no single factor which is taken into account. The Monetary Policy Committee takes into account number of factors, and it's not just inflation. They also closely look at the external account developments also, the current level of current account deficit, future outlook for the balance of payment and its impact on a current account, and also impact on our reserves, and also impact on exchange rate. So all those factors are taken into account. So then the committee takes a decision. And this is what they have done today also. So there is no single factor, whether it's core inflation or headline inflation or some other factor, which is based for which is taken into account for determining the level of policy rate, and which becomes the basis for that. So it's a wide spread, I will say, data set which is taken into account, and it's a data-driven approach which is adopted by the committee. Last point on the forward guidance, I think forward guidance is not even being currently being done by even some of the advanced countries, central banks. They have previously done in some cases, but most of the central banks, given the current level of uncertainty globally as well as in some domestic economies, so they are not providing any forward guidance. So for State Bank also, we are not giving any guidance on the policy rate future outlook, but we are more focused on assessing the impact of various policy decisions on the key macro indicators. And we share the outlook of the key macro indicators, as I said, but not any guidance on the policy rate outlook or the exchange rate outlook.
Thank you, Governor Saab. So I'll move to the next set of questions, which is on the FX inflows and impact on net international reserves. So I have a set of questions which were received in advance, and there's a similar question in the chat box. So I'll just club that together. So the question is, what are the reasons for scarcity of foreign exchange inflows, despite IMF program being in place? Do you see any possibility of accumulating reserves through market purchases, as the period of current account surpluses seems to be over? And the second question related to that is, how flexible is the IMF on the NIR target, and is the SPP expecting to meet the March 2025 target? Sir, please.
So on the first part, I think as you have seen during the current fiscal year, the official inflows are on lower side as compared to what was planned at the start of the year. And there are various reasons for that, but I will not go into that detail. But what I can say is that those inflows are still planned, and it's a matter of time only. Some of them which were expected to be received earlier will be received during the last quarter of this fiscal year. So overall, I think we will be able to make up the shortfall as far as the inflows are concerned, particularly once we have completion of the IMF review. Then with that, some inflows will be coming in. And similarly, on the commercial borrowing also, as I said in the previous briefing also, that the availability of borrowing is as such not an issue. It's more the terms on which we will borrow. And we have delayed some of those borrowings for the better terms. And we are hoping that with the passage of time and with further improvement in the economic indicators, the terms of the borrowing will also improve. And this is what we have seen in the case of Eurobond secondary market yields also, that our yields are now already in the single digit, which used to be much higher. So similarly, on the external borrowing, we are hoping that we will be able to borrow at better terms going forward. So the availability is there, and I think in the next quarters, you will see some borrowing will be done. The second part is of the question was about the IMF target on NIR. So there is no reason we should be seeking any flexibility on the NIR target, because we are right on track as far as the meeting of these targets are concerned. We have met the NIR target for December with a wide margin, and for June also we are quite confident that we will be able to meet that target. So there is no reason for asking for any flexibility as far as the NIR target, or for that matter any other targets which are meant to be complied by the State Bank are concerned. So we'll be meeting all those targets, quantitative targets, as per commitment with the IMF, and we'll be meeting them on time.
Thank you, Governor Saab. So the next we move to the next set of questions, which are on monetary indicators and banking sector indicators. So the first question is that with the decline in the policy rate, both advances and infection ratios of SME sector have increased in Q1 FY25. What remedial measure is the SPP taking to address this trend? The second question on the same topic is on the M2 growth, which has declined by 1.78% since June. Do you think this has created further room for policy rate cuts? And finally, sir, a third question, which
sorry, Noor, what was the second question?
So the second question is on M2 growth. M2 has declined by 1.78% since June. Do you think this has created further room for policy rate cuts?
Okay, and what was the third?
And sir, the third question is, a significant increase in OMO stock has been observed. Given the fiscal revenue shortfall, further rise in OMO stock is expected. Does the SPP see this as a source of concern?
Okay. So on the first question about the SMEs advances and infection ratio, I think there is as such no increase as far as the NPLs for SMEs are concerned. It's more that there was some reclassification from the corporates to SMEs, which resulted into change in the NPLs for and advances for the SME sector. So as such, there is no deterioration in the ratios. But at the same time, I will say that financial stability is an area which State Bank is quite focused on, and this is one of the key objectives under our law, State Bank of Pakistan Act, which we have to achieve. And for that, we closely monitor the financial stability in individual banks as well as in the overall banking system. And we keep a very close watch on the infection ratio in the overall banking system. And when we look at the current levels of infection of portfolio, we see that financial sector is banking sector is quite healthy, and the key ratios of the sector are in line with the international standards and much above the requirements of the state bank from regulatory perspective. So I don't see any deterioration in the key indicators of the banking sector. I will come to the third question now on OMO, and then maybe Amin Saab, you can respond on the second part, M2. So the third question was about the OMO stock increasing trend and cause of concern for SPP or not. So I will say that OMO target, yes, there is some increase recently, but there are reasons for that. And there are two key reasons. I will say number one is that the currency in circulation has recently increased because more of the seasonal pattern, because we are in Ramadan already, and then it will be followed by Eid festival. And normally during Ramadan and Eid festival, these days the currency in circulation increases in order to meet the cash requirements by individuals and other stakeholders. So with that, the OMO also there is an increasing trend. And secondly, the important reason is the borrowing, elevated level of borrowing of the government. And this is mainly due to the reasons that some of the, as we were just discussing, that some of the FX inflows, planned inflows, official inflows, which were expected to be received earlier, have not yet been received and will be received later on. And in order to, and since the government has already serviced a sizable foreign exchange debt already, and as I shared, close to $7 billion has already been repaid. And since the inflows were less than that, so in order to meet this increased level of debt repayments, which were expected to be refinanced from the inflows, and those inflows have been delayed. So the government have to borrow in local currency in order to make those debt repayments. So that's the reason, because of this increased demand, the bank's liquidity position has came under stress, and they have come to the SBP for OMO operations. So we are hoping that this with the inflows coming, this situation will improve over time. Amin Saab, if you can respond to second.
Thank you, Governor Saab, and thank you for asking this question. So I would like to say two things here. Number one, quantity aggregates. Yes, this is one of the indicators among all other indicators that multi-policy look at and analyze. And as you know that this quantity aggregate normally have a relationship or long-term relationship with inflation. So that has come down, the growth, which is a welcome sign in the last few months. And this was expected because when the inflation was coming down and nominal GDP is coming down, so that should have come down. So so even the current level around 11.5, if we look at, and if we see our inflation projection range and GDP growth range, so still our nominal GDP would be slightly lower than what the M2 is. But nevertheless, as I said, like when multi-policy make the assessment, they analyze all the variable, including M2. So they don't just make decision based on one indicator versus other, but overall what the picture is and what is how it affects the outlook of inflation and other macroeconomic variables. Thank you. Over to you, sir.
Thank you, Governor Saab, and thank you, Amin Saab. Sir, we have one final question in the chat box, and I think after that I'll request you for your closing remarks. The question is related to the cap on 3 million car financing. It's asking if there is any, forward view on removing that cap?
Sorry, cap on?
Cap on car financing.
Car
3
financing.
million rupees
Yeah.
cap on car financing.
So I think for the time being, we are continuing with the current regulatory requirements on consumer financing. So as such, there is no immediate plan for any change. But going forward, we will continue to assess the situation, and if warranted, then we'll have a relook at it. But as such, at this stage, there is no plan for any change as far as the consumer financing regulations are concerned.
Thank
Yes.
you, Govind Saab. Before we close the session, if you would like to make some parting remarks, sir.
I think I will say thank you very much to all the participants, and I hope they will be able to have their own assessment of the current situation. But we have tried in a very pragmatic way that we share the analysis and data and decisions and discussions of the Monetary Policy Committee with all of you, and given the current trends and developments. So we hope that we will continue to do this in future also. So look forward to meet all of you again during the next briefing, which will be in first week of May. Thank you so much.
Thank you, Govind Saab and Amin Saab, and for everyone's participation. We close the session, sir. Thank you.